Welcome to the Time Books Podcast. I'm your host, and I am incredibly excited for today's session.
Me too. This is a big one.
It really is, because we are opening a door that, quite frankly, most people keep double-bolted, chained, and maybe even welded shut of a pure fear.
Oh, yeah. It's a topic that brings up a lot of anxiety.
Exactly. We're talking about the central tension of your financial life. And it isn't just about how hard you work or, how brilliant your ideas are.
Hmm.
It is about this massive gaping canyon between making money.
And actually keeping money.
Yes, that's the whole thing.
It's the silent killer of wealth. I mean, I've seen it 1,000 times. You can work 80 hours a week. You can have the best year of your career. You can launch a product that everyone loves.
You can do everything right. By the book.
By the conventional book, yes. But if you have a hole in your pocket, you're just running on a treadmill. You're sweating, you're moving, but you aren't actually getting anywhere.
And that hole, more often than not, it isn't the daily coffee or the avocado toast everyone loves to blame.
It's not even close. It's taxes.
Exactly. And to guide us through this maze, we are diving into a really fascinating book today. It is titled Ways to Avoid Taxes: Ultimate Guide to Creating Tax-Free Wealth and Keeping More of Your Money Legally, by Tommy D. Heckman.
It's a bold title.
It is a title that promises the world. Very bold.
And you know what? It delivers on a premise that I think is essential for everyone to understand. I don't care if you're making minimum wage right now or you're pulling in 7 figures. The premise is...
What's the core idea?
The premise is that taxes are likely the single biggest expense you will pay in your entire lifetime.
Whoa. Say that again?
Think about it for a second. More than your mortgage on your dream house.
Which is already a huge number.
Right. More than your kids' college tuition, which we know is just astronomical these days. More than food, cars, utilities combined.
That's a staggering thought.
It is.
Yeah.
Yet, and this is the crazy part, most people treat taxes as a fixed cost. They think, well, I made this much, so I owe this much. That's just how it is.
Like gravity. You
Yeah.
can't change it.
Exactly. It's like gravity. I can't change it. But Heckman's argument, and it's a powerful one, is that taxes are not a fixed cost. They are not like gravity. They are a variable.
A variable you can control.
A variable you can control if, and this is a big if you know the rules of the game.
To set the stage for this, I want to go right to the opening of the book, because Heckman starts with a story that it really grabs you.
It's the perfect way to start.
It sets the emotional stakes perfectly before we even touch the math. He talks about sitting in the living room of a man who had built a $15 million empire.
Yeah, this is such a great scene setter. It grounds all these, abstract concepts in a real person's life.
It really does. And he describes this guy. He's older, nearing 70, gray-haired, but his eyes are sharp as a whip. He's sitting there just sipping black coffee from a plain white mug.
No flash.
No flash at all, no Rolex, no designer suit, just substance. And this man built everything from scratch. No trust fund, no inheritance, just pure grit and decades of just grinding it out.
Classic American dream story.
Totally. And he tells Heckman something that he says hit him like a freight train. He says the hardest part wasn't making the money, it was keeping it.
And when he said that, he wasn't talking about stock market crashes or anything like that.
No.
He wasn't talking about bad business deals or theft or embezzlement.
He was talking about the IRS.
Right. And the context there is,
Yeah.
it's heartbreaking, but it's so educational. This man, early in his career, had been completely blindsided.
He just didn't know.
He had a massive year, the kind of year entrepreneurs dream of, right? Made a ton of profit, was on top of the world, and then got hit with a tax bill that wiped out nearly half of everything he had built.
I can't even imagine that feeling, the deflation.
It's a trauma, and that trauma essentially forced him to learn the game.
Yeah.
He realized that the government was his silent partner.
A silent partner. I like that phrasing.
A partner who takes a cut right off the top, contributes zero capital, and takes none of the risk.
None of the risk. You're the one staying up all night. You're the one taking out the loans.
Exactly. And he realized if he didn't manage that partnership, he was going to lose. So he spent the next several decades learning to outsmart the system, not by breaking the law,
Which is the key distinction.
but by understanding the law better than the average person and even better than the average accountant.
That brings us to the elephant in the room, which we have to address right up front before we get into any of the strategies.
You have to.
There is this feeling, I think, for a lot of people, that tax avoidance just sounds, well, shady.
It does. It has a negative connotation.
It sounds like something guys in movies do right before the FBI raids their office in a dramatic scene.
It's a very common misconception, and it's a dangerous one. We have to draw a hard, bright line here, just like Heckman does in the book. There is a world of difference between tax evasion and tax avoidance.
Okay, let's define those.
Evasion is hiding money under the mattress. It's cooking the books, not reporting income, lying to the IRS. That is criminal. You go to jail for that. You pay massive fines. It's unethical and it's illegal.
Full stop. Don't do that.
Don't do that. Tax avoidance, on the other hand, is simply arranging your financial affairs in a way that minimizes your liability according to the law that's already written. It's using the rules as they exist.
The book actually quotes some heavy hitters to back this up. It's not just some, loophole theory from a blog. It's actual judicial philosophy.
It is. There is a famous quote from Judge Learned Hand, a U.S. federal judge, who said, "There is not even a patriotic duty to increase one's taxes."
Not even a patriotic duty. That's a powerful statement from a judge.
He essentially said, nobody owes the government more than the law demands. You don't tip the IRS.
Right.
If the bill is $100, you don't pay $120 just to be nice.
And then you have John Maynard Keynes, the famous economist, who said, "The avoidance of taxes is the only intellectual pursuit that carries any reward."
I love that quote.
Me too. It frames it as a puzzle to be solved rather than a burden you just have to carry.
Exactly. And the mission of this podcast today is to walk through Heckman's playbook. We are going to explore the entire book, the stories, the quotes, the practical lessons on how the wealthy play this game.
You call it a game.
I use the word game deliberately because once you know the rules, it stops being the source of anxiety and it starts being a strategy. It becomes chess.
So our goal here is to take what Heckman has laid out in Ways to Avoid Taxes and make it accessible. Whether you are an entrepreneur, a W-2 employee, or just someone curious about building wealth, there's something here for you.
Absolutely. Let's do it.
So let's unpack this. We are starting with principle 1 from the book, which is the mindset shift.
The foundation.
Heckman argues that before you even look at a tax form, before you download an app or hire a CPA, you have to fundamentally change your brain.
It all starts up here.
He uses this analogy that I love, the tale of two shoppers.
This is a classic example of perspective. So picture two people walking into, say, an electronics store. Person A, let's call him the average consumer, looks at a price tag on a high-end laptop. Let's say it's $3,000.
Okay.
He looks at that number and asks one question, and only one question. Can I afford this?
Right. That is a scarcity mindset. It's about depletion. It's about money leaving the wallet and never coming back.
The internal monologue is, do I have enough left over to survive and pay rent if I buy this thing?
Totally. It's a defensive posture.
Exactly. Now, person B, the person with the wealthy mindset, walks into the same store. They look at the exact same laptop, same specs, same price tag. But they ask a completely different question.
Which is?
How can this pay me back?
Oh, I like that. How can this pay me back? It just flips the script entirely, doesn't it?
100%. They aren't seeing a cost. They are seeing an investment and a deduction. They are thinking, okay, if I buy this laptop for my business, it lowers my taxable income because it's a necessary business expense.
So right there, the price is effectively lower.
Instantly. The government is subsidizing the purchase. So that $3,000 laptop might only cost them, say, $2,000 after the tax savings.
And that's before it even does anything for them.
Exactly. Then they think, plus it helps me generate more revenue because it's a faster, better tool. I can edit videos quicker. I can run my software better. It's a shift from seeing money as something you spend to seeing money as a tool for leverage. They are calculating the return on investment and the tax savings at the same time.
It reminds me of the distinction the book makes between labor and leverage. There is this really vivid image of a man digging a well with a spoon.
It's a painful image, isn't it?
It really is. You can respect the guy's work ethic. He's up at dawn, he's digging all day, he's sweating, he's exhausted. By all societal standards, he is a hard worker. He's doing everything right, according to the old playbook.
But he's using a spoon.
He's using a spoon, and
Yeah.
he's wondering why he's not getting anywhere fast.
And that is the hamster wheel. That is working for money. You are trading your time for dollars. The problem is you eventually run out of time. You can only work so many hours in a day.
There's a hard cap.
There's a hard cap. And Heckman calls this glorified struggle. We are culturally conditioned to applaud the struggle, the long hours, the burnout, the grind set.
Oh, for sure. It's a badge of honor.
But wealth isn't built on struggle alone. It's built on strategy. The wealthy person doesn't dig with a spoon. They rent an excavator. That's leverage. They trade value, not time. And the tax code, this is the important part, rewards the excavator, not the spoon.
And the tax code actively penalizes the spoon digger, doesn't it? This is the part that feels almost unfair until you understand why it exists.
Severely. W-2 income, the income you get from a standard job, is the highest taxed income there is
Why is that?
because it's taxed before you even see it. You get your paycheck, and the government has already taken their cut for Social Security, Medicare, federal, and state tax. You have zero control.
The money never even hits your bank account.
Never. The wealthy, on the other hand, prioritize income that they control. Income where they pay expenses first and then pay taxes on whatever's left over. It's a completely different sequence of events.
This brings up the emotional side of things. I think for most of us, when we get a tax bill or we think about April 15th, the primary emotion is like panic. It's fear. Did I mess up? Do I owe more than I have?
Fear, annoyance, and resentment. It just ruins the month.
Right. But Heckman says the wealthy don't feel panic. They feel
What?
strategic.
Because they are proactive. The average person reacts to taxes. They wait until the year is over, usually around February or March. They hand a shoebox of crumpled receipts to a tax preparer, and they just hope for the best.
The pray and pay method.
That's a recipe for anxiety. It's like driving a car blindfolded and hoping you don't hit a wall. The wealthy person is planning months, sometimes years in advance. They are making moves in October and November to affect what they pay next April.
They're playing offense, not defense.
Exactly. They view money not as the finish line, oh, I made $100,000, I won, but as a tool to build the next layer of the fortress.
So here is a challenge for everyone listening right now. Ask yourself, honestly, are you digging with a spoon? Are you just working for money, or is your money starting to work for you?
And it's a hard question to ask yourself.
It is, but if you are just trading hours for dollars and hoping the tax man is pined at the end of the year, you are playing the game with one hand tied behind your back.
And that's a hard place to be.
Yeah.
But asking that question is the first step. You have to decide to stop being a passive participant in your own financial life.
Okay, let's move to segment 2, which is all about how we earn. The book has this phrase I love, earn smarter, and it talks about a concept called streams, not puddles.
This is such vital visual imagery. A puddle is stagnant. It just sits there. If the sun comes out, it evaporates. If it doesn't rain, it dries up.
That's a single paycheck.
It is a single paycheck. It feels safe because it arrives every 2 weeks, like clockwork, but it's actually incredibly risky. If that one faucet turns off, you get fired, the company folds, you get sick, you have a drought immediately.
The book advocates for income streams. And I want to be clear here because Heckman emphasizes this. We are not just talking about tycoons owning factories or, tech startups.
No, absolutely not. The inclusivity here is really important. He mentions teachers writing ebooks on the side,
Right.
mechanics making YouTube videos about car repair, graphic designers selling templates online. It's about taking what you know or what you do and detaching the income from your physical presence, creating something that can make you money while you sleep.
And this leads to the concept of hiding in plain sight. The book talks about how these secrets aren't buried in a vault at the Federal Reserve. They are literally in the tax code.
It's all in the publications. He mentions publication 535, for example. It's boring reading for most people. I mean, it's dry as dust, tiny font.
It'll put you to sleep.
It will, but it's a treasure map. The IRS basically publishes a rule book on how to pay them less, but most people never open the cover.
Walk us through the two faucets analogy from the book. I thought this was a brilliant way to visualize the flow of money.
It's a great visual. Imagine faucet number one.
Mhm.
This is your standard salary, your W-2 income. The water comes out, but it flows directly into a drain labeled taxes.
It gets intercepted.
Immediately intercepted by withholding. And you're trying to catch what you can in your hands, but
Yeah.
the flow is just diverted. You are fighting against gravity.
Okay.
Now imagine faucet number two. This is passive or strategic income. This water trickles into a bucket, and the bucket has a lid. It seals. The water stays inside, and it multiplies.
So you have control.
You have total control. This is income from real estate, dividends, or business profits. You choose when to pour it out, and you choose how much tax to pay on it based on how you use it.
So let's get specific. The book has a section called Income That Pays Zero. Now that sounds like clickbait, honestly.
It does.
If I saw that on a YouTube thumbnail, I'd probably scroll right past thinking it's a scam. But he backs it up with the tax code. What are these magical income sources?
They aren't magic. They are policy. And we have to understand that the tax code is a system of incentives. The government wants to incentivize certain behaviors that help the economy.
Like what?
They want housing for people, so they incentivize real estate investors.
Yeah.
They want business growth and jobs, so they incentivize capital investment and entrepreneurship. They want you to do the things they can't do efficiently themselves.
Okay, so give us the breakdown. Real estate first. How can that possibly pay zero in taxes?
Real estate is the undisputed king of tax-advantaged income. So you have cash flow, that's the money left over after you pay the mortgage, insurance, and repairs.
Money in your pocket.
Money in your pocket. You can spend that at the grocery store. But then you have this thing called depreciation. The IRS lets you assume the building is wearing out the roof, the floors, the structure. So they let you deduct a portion of the building's value every single year as an expense. It's a phantom expense.
Phantom expense. Explain that term. What does that mean?
It means you didn't actually write a check for it this year. You bought the building years ago. But on your tax return, you get to say, I lost value, even if the property value actually went up.
That's the crazy part.
It's wild. So you could have $10,000 in actual cash in your pocket from rent. But on paper, because of the depreciation deduction, you show a loss. You pay zero tax on that $10,000.
Zero.
In fact, that loss can sometimes be used to offset other income you have from your job or another business.
That is just mind-blowing when you really think about it. You have the cash to buy groceries, but the IRS sees you as losing money?
It's completely legal. It's how the code is written. Then you have long-term capital gains.
So this is for stocks, assets.
Right. If you hold an asset, a stock, a property, a business for more than 1 year and a day, you pay a significantly lower tax rate when you sell it compared to your salary.
And for some people, that rate is...
It can be 0%.
0%.
Zero. If you are in the lower income brackets, for a married couple filing jointly in 2024, if your taxable income is under roughly $94,000, your long-term capital gains tax rate is 0%.
So you could sell stock for a $50,000 profit.
And keep every single penny if your other income is low enough to keep you in that bracket.
That's a huge incentive to invest and hold.
A massive one.
Yeah.
And then there is the life insurance loan strategy, which we can dive deeper into later. But the gist is you're borrowing against your own money tax-free.
How does that work?
Debt is not taxable. If you take a loan from a bank or from your insurance policy's cash value, the IRS doesn't consider that income because you have an obligation to pay it back. So if you can structure your wealth so you are living off loans secured by your assets, you are technically earning nothing, paying no tax, but living a very comfortable lifestyle.
It is so counterintuitive. We are taught from kindergarten that making more money means paying more tax. It's a straight line up.
Right.
But Heckman is saying, no, if you make the right kind of money, you can make more and pay less.
Precisely. It's about the character of the income, not just the amount. Not all dollars are created equal. A real estate dollar is worth more than a salary dollar because you get to keep more of it.
Let's move on to segment 3. Principle 2, let deductions work. The book calls this the umbrella strategy.
I love this analogy because it's so simple. It's raining. That's taxes. It's just a fact of life. One person stands there and gets soaked to the bone.
Miserable.
The other person opens an umbrella. The rain is still falling. The tax rates haven't changed, but they aren't getting wet. Deductions are the umbrella.
The core philosophy here is that famous saying, it's not about what you earn, it's about what you keep.
That's it. That's the whole game in one sentence.
And the way to keep more is to corporatize your lifestyle. Now, this is where listeners need to pay close attention because this is actionable right now. The rule is, if you're going to spend the money anyway, make it work for you.
This is the shift from a personal expense to a business expense. But, and I have to stress this, and Heckman stresses this repeatedly, it has to be legitimate.
Right, this is not about fraud.
Not at all. You can't just buy groceries for your family and call it a business meeting.
Yeah.
That is fraud. However, there is a lot of overlap in our lives that we completely ignore from a tax perspective.
Okay, so let's look at the examples from the text. Dining. We all have to eat.
We all eat. If you go out to dinner with a friend who is also a potential client or a business partner or a consultant you're trying to learn from,
And you talk business.
and you discuss business strategy, new markets, problems you're solving, that meal is now a business meeting. You can deduct 50% of that cost. You were going to eat anyway. You were going to spend that money. But by adding the business intent and documenting it, you just saved money on your taxes.
Travel is another huge one. The Miami trip example in the book. This one feels like a cheat code.
This is a classic. You want to go to Miami. If you just go for a vacation, sit on the beach, drink mojitos, it's 100% personal. No tax benefit. It costs you full retail. But let's say you schedule a workshop, a seminar, or meetings with clients in Miami for Thursday and Friday. Now, the primary purpose of the trip is business.
So what does that actually cover? What becomes deductible?
The flight to get there is deductible. The Uber from the airport to the hotel is deductible. The lodging for the business days, Thursday and Friday, is deductible. A portion of your meals is
Like
deductible.
when you stay for the weekend.
Then you stay for Saturday and Sunday for your personal beach time. You can't deduct the hotel for Saturday and Sunday. That's personal.
Mm-hmm.
But you've already deducted the flight to get there and back. You have effectively subsidized your vacation with pre-tax dollars.
But the caveat here is huge. It's all about documentation.
It is the absolute difference between winning and losing an audit. The IRS runs on paper. If it's not written down, it didn't happen.
So what do you need?
You need a logbook. You need receipts. You need to note who you met with, the date, and what was discussed. Dinner with John Smith discussed Q3 marketing strategy. That's all it takes. If you have that, you are bulletproof. If you don't, you are completely exposed.
Let's talk about the home. Heckman calls it your home as a haven, but not just as a shelter for people, but a shelter for money.
The home office deduction is the one most people have heard of. If you use a space in your home exclusively and regularly for business, a spare bedroom, a den, even a corner of a room.
It has to be exclusive, right? You can't also use it as a playroom.
Right. Exclusive use is key. You can then deduct a portion of your mortgage interest, your utilities, your insurance repairs, based on the square footage of that office relative to the whole house. If your office is 10% of your home's square footage, you can deduct 10% of all those bills.
But there's a hidden gem in the book that I absolutely love, the master's rule, or the Augusta rule. I had never heard of this before reading this book.
This is my favorite one to share because almost no one knows about it, and it sounds illegal, but it's specifically written into the tax code. It's Section 280A.
Why is it called the Augusta rule?
It's named after the Masters golf tournament in Augusta, Georgia. Residents there wanted to rent their homes out to golfers and fans for that 1 week a year without navigating a tax nightmare. So the lobbyists got to work.
And what's the rule?
The code allows you to rent your primary residence for up to 14 days a year, and the income you receive is 100% tax-free.
Wait, let me make sure I heard that right. I can rent my house for 2 weeks, make, I don't know, $5,000, and I don't even have to report that income.
You don't even have to put it on your tax return. It's like ghost income. As long as it is 14 days or less, if you rent it for 15 days, you have to report all of it. But 14, it's tax-free.
Okay, that's amazing on its own. But Heckman points out an advanced strategy for business owners.
This is the master stroke. If you own a business, say an S-Corp or LLC, your business can rent your home from you for things like board meetings, strategy sessions, or video shoots.
So I am renting my own house to my own business.
Yes. The business pays you, the individual, fair market rent for the day. The business gets a tax deduction for that rent expense because it's a legitimate venue cost.
Okay.
And you personally receive that rental income tax-free under the Augusta rule. You are literally moving money from your taxable business pocket to your tax-free personal pocket legally.
That is brilliant. It's one of those things that is fully legal, but you have to know it exists to be able to use it.
And you need to have market rate documentation. You can't charge your business $10,000 for a 1-hour meeting in your kitchen.
Right. It has to be reasonable.
But can you charge $1,000 for a full-day off-site meeting if that's what a local hotel conference room costs?
Absolutely.
Get a quote from a local hotel to prove the rate, write up a rental agreement between you and your company, and you're set.
This section also mentions energy efficiency, solar panels, windows. These are tax credits, which are different from deductions, right? Better.
Much better. A deduction lowers the income you are taxed on. So if you are in the 24% bracket, a $100 deduction saves you $24. A credit lowers your actual tax bill dollar for dollar.
It's a direct reduction.
It's like a gift card for the IRS.
Yeah.
If you owe $5,000 in taxes and you have a $1,000 solar tax credit, you now owe $4,000. It's much more powerful.
Okay, let's step up the complexity a bit. Segment 4. We've talked about lifestyle, but now let's talk about the structure itself. Business as the ultimate tax shelter. Heckman uses the image of a fortress.
The business entity like an LLC or an S-Corp is the wall of the fortress. It separates your personal assets from your business liabilities. If someone sues the business, they can't take your house. That's the legal protection. But it also creates a different tax reality.
And the book highlights the self-employment tax strategy using an S-Corp. This is called the bread and butter strategy for anyone making decent money on their own.
It really is. It's fundamental.
So break that down for us. What is the math there?
Okay, let's say you are a consultant and you make $100,000 in profit for the year. If you are a sole proprietor, meaning you have no formal entity.
Just you doing business as yourself.
Right. You pay income tax on that full $100,000. PLUS, you pay self-employment tax, which is Social Security and Medicare. That self-employment tax is roughly 15.3% on every dollar.
Wow, that's a lot.
So that's about $15,300 right off the top before you even calculate your regular income tax.
Oh,
It hurts.
ouch. Yeah. So how does the S Corp change that?
Now, if you form an S corp, you can split that income. The IRS says you must pay yourself a reasonable salary. Let's say for your role, a reasonable salary is $50,000. You pay that to yourself via payroll, and you pay the 15.3% tax on that $50,000.
Okay, so you're still paying it on part of the money.
On part of it, yes.
Yep.
But the remaining $50,000, you take that as a distribution of profit. Distributions are not subject to Social Security and Medicare taxes.
So you just avoided that 15% tax on the second half of your money.
Exactly. You saved roughly $7,600 in taxes just by changing the legal structure of your business. Same work, same income, nearly $8,000 more in your pocket.
That's a game changer.
A total game changer.
Another strategy in this fortress concept is family employment, hiring your kids. Now, this feels like one of those things that sounds too good to be true, but the book says it's a powerful way to build generational wealth.
It creates this beautiful, virtuous cycle. So you hire your child to do legitimate work for the business. If they are 7, maybe they are emptying trash cans and shredding paper.
Or modeling for your website.
Or modeling for your website, exactly.
Yeah.
If they're 14, maybe they are managing your social media or doing data entry. You pay them a reasonable wage for that work.
Okay, so money goes from the business to the kid. What happens next?
Right. So your business gets a tax deduction for that wage, which lowers your business income and your tax bill. The child then earns the income. Now, because of the standard deduction, which for a single person in 2024 is around $14,600, if the child earns less than that amount, they pay 0 federal income tax.
So the business deducts it, lowering your tax, and the kid pays 0 tax on it. The tax just evaporates.
And it vanishes. The money is moved from a high tax environment, which is you at 24% or 32%, to a 0 tax environment, which is your child. And then, here's the kicker.
There's more.
There's more. Since the child now has earned income, they are eligible to take that money and put it into a Roth IRA.
And we know the power of a Roth IRA.
It's financial nuclear fission. That money grows tax-free for 50 or 60 years. If you put $6,000 a year into a Roth for your kid from age 14 to 18, and they never add another dime, by the time they retire, that account could be worth over $1 million. All of it completely tax-free. You are setting them up to be millionaires, all with money that was never taxed by the federal government to begin with.
That is just so powerful. That is playing the long game on a whole different level.
It really is. It also shifts the burden away from you having to support them in your retirement years.
And briefly, let's touch on Section 179 and bonus depreciation. This is for equipment purchases, right?
Right. People used to call it the Hummer loophole because you could write off a heavy vehicle.
Right, but it applies to machinery, computers, office furniture.
Anything for the business.
Yeah.
Normally, if you buy a $50,000 machine for your factory, you have to deduct the cost over several years, say 5 or 7 years. You get a little deduction each year.
Section 179 changes that.
It lets you write off the entire purchase price in the year you buy it. So if you're having a high-income year and you need to lower your profit to save on taxes, you can go buy that equipment you were going to buy anyway, take the massive deduction immediately, and drastically lower your tax bill. It encourages businesses to reinvest in themselves.
Let's move to Segment 5, Principle 3, Building Tax-Free Wealth. We have this great story about Harold Griffin.
I love Harold. He's the antidote to the flashy billionaire stereotype. Harold wasn't a tech genius. He was a school principal.
Right.
He didn't invent an app. He didn't win the lottery. But he retired wealthy and, more importantly, free of financial stress.
So what was Harold's toolbox? How did a regular school principal beat the system?
He used the long game tools that are available to absolutely everyone. First, the Roth IRA. We mentioned it with the kids, but for Harold, it was his bedrock. You pay tax on the money before it goes in, so you feel the pinch today.
But then what happens?
But then it grows tax-free forever.
Right.
When he withdraws it in retirement, the IRS gets nothing. Not on the principal he put in, not on the millions of dollars in growth. It is a beautiful thing.
And then the HSA, the health savings account, the book calls this the triple threat. I feel like HSAs are so misunderstood. People think they are just for buying glasses or aspirin.
They are the secret weapon of the tax code. It is the only account that has triple tax advantages. 1, you get a tax deduction when you put money in, just like a 401k.
Okay.
2, it grows tax-free like a Roth. And 3, if you use it for medical expenses, it comes out tax-free. It's the holy grail. of tax-advantaged accounts.
But there is an advanced strategy here that Harold used, right?
Yeah.
The book calls it the shoebox strategy.
Yes, most people use their HSA to pay for the doctor visit today. Harold didn't do that. He paid his medical bills out of his own pocket with cash.
So what did he do with the HSA money?
He let the HSA money stay invested in the market, in stocks and bonds, growing at 7% or 8% a year.
Ah.
But, and this is the key, he saved all his receipts for those medical bills he paid. He kept them in a shoebox or, digital folder.
Why save the receipts if you already paid the bill?
Because there is no time limit on reimbursing yourself from an HSA. Years later, in retirement, Harold can take those receipts from 20 years ago and reimburse himself for those old expenses.
No way.
Yes. He pulls that accumulated growth out of the account completely tax-free to buy a boat or go on vacation because technically it's a qualified medical reimbursement. It turns the HSA into a stealth retirement account with better tax perks than a 401k or a Roth.
That is incredibly savvy. And he also used the home sale exclusion.
He downsized. He sold his big family home after the kids moved out. The tax code section 121 allows a married couple to exclude up to $500,000 of capital gains on the sale of their primary residence.
$500,000 tax-free.
So Harold bought his house for $100,000, sold it for $600,000. That $500,000 profit. Zero tax. He took that massive chunk of tax-free capital and moved into a smaller place, investing the difference to create income.
And finally, municipal bonds.
The boring but beautiful investment. You lend money to a local government for a bridge or school. They pay you interest. That interest is free from federal taxes and usually state taxes too if you live in that state. It's just steady, reliable, tax-free income.
Okay, segment 6 is where we get into the heavy machinery, the real estate code, and the rich man's Roth.
We touched on real estate earlier, but let's go deeper. We talked about depreciation being the phantom expense. But the 1031 exchange is the rocket fuel.
This is the trade-up strategy.
That's right. If you sell a rental property for a profit, normally you'd pay capital gains tax and something called depreciation recapture tax. That could eat up 25–30% of your profit right there.
Which kills your momentum.
Kills it. But with a Section 1031 exchange, if you use that money to buy another like-kind property, usually a bigger or more expensive one, within a certain time frame, you can defer the tax. You don't pay it. You roll it into the next property.
So you're just kicking the can down the road.
You're kicking the can down the road, and your snowball of money gets bigger and bigger because you aren't shaving off 30% every time you sell. You can do this over and over again, from a duplex to a fourplex to a whole apartment building.
Defer, die. That's the morbid little phrase in the industry, isn't it?
It is because of the step-up in basis. If you defer taxes your whole life by trading up properties and then you pass away, your heirs inherit the property at its current market value on the day you die.
So what happens to all those deferred taxes?
They vanish, wiped out, gone forever. Your heirs can sell a property the next day and pay zero capital gains tax on all that appreciation you built up over a lifetime.
That is an incredible wealth transfer tool. It essentially erases a lifetime of tax liability upon death.
It's the most powerful one in the entire code, arguably. And then you have cost segregation. This is for the real pros.
What is that?
Instead of depreciating a building over 27.5 years for residential or 39 years for commercial, you hire an engineer to do a study. They say, hey, the carpet, the lights, the fence, the parking lot, those things wear out faster than the foundation and the walls.
Right. That makes sense.
So you can depreciate those components on a much faster schedule, like 5 or 7 years. Or, with bonus depreciation rules, sometimes you can write it all off in year 1. It front-loads your tax savings. You can create massive paper losses to offset other income.
Now, let's talk about the rich man's Roth. This is referring to permanent life insurance whole life, or indexed universal life, or IUL. I know this can be controversial.
It is controversial, and for good reason. High fees can eat up your returns if the policy is structured poorly. But Heckman defends it vigorously as a tax tool if it's structured correctly for maximum cash value, not for the death benefit.
So the key is you aren't buying it hoping to die.
No, you are buying it for the cash value. As you pay your premiums, a portion of that money goes into a savings component inside the policy. It grows tax-deferred, shielded from the market in some cases. But here is the magic trick.
The loan.
You can borrow against that cash value.
And as we already established, loans are tax-free.
Correct. You are literally becoming your own bank. You borrow your own money to buy a car or invest in another business. The policy keeps growing, as if the money is still there in many cases, and you can pay the loan back on your own schedule.
And there are no contribution limits like a Roth IRA.
Exactly. You can't put $100,000 a year into a Roth. You can put $100,000 a year into a properly designed insurance policy. That's why it's called the rich man's Roth. You can dump huge amounts of cash in there to grow in a tax-protected environment.
The book has a quote from a professor: they're not buying death benefits, they're buying tax-free income.
It's a liquidity tool. It's a place to park cash where the IRS can't touch the growth, and you can access it whenever you want via those tax-free loans.
Okay, finally, segment 7. Principle 4, protect and pass it on. This is all about legacy.
This is where it gets really serious. The 40% trap. If your estate is over the exemption limit, which is high right now, around $13.6 million per person, but it's scheduled to drop significantly in 2026.
It's going to get cut in half, basically.
Basically, yes. The government takes 40% of everything above that line.
40%. That is nearly half your life's work.
It is. And Heckman talks about the tragedy of families having to sell the family farm or the family business just to pay the tax bill.
Why?
Because they're asset rich, they own land, machines, buildings, but they're cash poor. The IRS wants a check for cash within 9 months of death. If you don't have it, you have to sell the legacy itself just to pay the tax on it.
So how do we avoid that trap? The book points to trusts.
A will is not enough. A will goes through probate court. It's public record, it's expensive, lawyers take a big cut, and it takes a lot of time. A trust is private.
Let's distinguish between revocable and irrevocable for us.
A revocable living trust is great for avoiding probate. It creates privacy and speed. But it doesn't save you a dime on estate taxes because you still control the assets. You can change your mind, take the money back. So the IRS says it's still yours.
So what's the solution?
An irrevocable trust. This is the vault. You move assets into it. Technically, you don't own them anymore. The trust does. Because you don't own them, they aren't included in your estate when you die. The IRS can't tax what you don't own.
And the IL8, the Irrevocable Life Insurance Trust.
This combines the two powerful concepts. If you own a $5 million life insurance policy in your own name and you die, that $5 million is added to your estate's value.
And that could push you over the limit.
It could push you over the limit and trigger a huge tax bill on that money. If the ILite owns the policy instead, the $5 million pays out to the trust, fully and completely tax-free. Your heirs get every penny to pay estate taxes or just to live on.
And finally, strategic gifting.
You can give away money while you are alive to reduce the size of your estate before you die. There's an annual exclusion. Right now, it's around $18,000 per person per year.
So a married couple can give $36,000.
To as many people as they want. If you have 3 kids and 5 grandkids, you and your spouse can move a lot of money out of your estate tax-free over time.
And valuation discounts. This is complex, but sounds fascinating.
It is. If you gift a minority stake in a family business, say 10%, it's not actually valued at exactly 10% of the total business value.
Why not?
Because a minority owner has no control. They can't force a sale. They can't fire the CEO. No one would buy that 10% for full price on the open market. So the IRS allows you to discount the value of that gift, maybe by 20 or 30%. You can gift more underlying value while using up less of your lifetime tax exemption. It's a way to pass on the business at a sale price for tax purposes.
The philosophy here is die rich, not taxed. Or, as the book puts it, own nothing but control everything.
That is the ultimate mantra of the ultra-wealthy. If you own nothing in your own name, you have no liability, lawsuits can't touch you, and you have no estate tax. But if you control the entities that own all the assets, you have all the benefits of wealth without the risks.
Wow. Okay, let's breathe for a second. We have covered a massive amount of ground here.
We have.
We've gone from digging with spoons to building entire fortresses and vaults for our wealth.
It's a journey from being a victim of the tax system to being a master of it.
So, to summarize the legal loop, as Heckman calls it in the book, you earn your money inside a business entity to control the flow.
Step 1.
You deduct every legitimate expense you can to lower that taxable income.
Step 2.
You invest the savings into tax-favored assets like real estate or a Roth IRA.
Step 3. Growth.
And finally, you protect it all for the next generation in trusts.
That is the cycle.
Yeah.
Earn, deduct, invest, protect, and then you rinse and repeat your whole life.
To everyone listening, here is the reality check. Heckman says, knowledge without action is a locked vault. We have given you the combination today, but you are the one who has to turn the dial.
Don't just nod along and say, wow, that was interesting. You have to do something.
Here are your action steps. 1. Review how your assets are titled. Do you own them personally or does your business? 2. Start tracking your expenses today. Don't wait for tax season. Get an app, get a logbook, whatever it takes. And 3,
Stop digging with a spoon.
stop digging with a spoon. Look
Okay.
for leverage everywhere.
And honestly, step 0 is to educate yourself further. We've given you the 30,000-foot overview, but the devil and the salvation is in the details. You need to consult with a qualified CPA or tax strategist who understands these aggressive but legal strategies. Most tax preparers just fill out forms. You need a strategist who thinks like this.
Absolutely. And I strongly recommend you pick up the book we've been discussing, Ways to Avoid Taxes, Ultimate Guide to Creating Tax-Free Wealth and Keeping More of Your Money Legally by Tommy D. Heckman.
Treat it like a manual.
Yes. Don't just read it once. Highlight it. Keep it on your desk. Refer back to it.
It's the kind of book that pays for itself with one single strategy. If you just use the Augusta rule one time, the book pays for itself 100 times over.
And we want to hear from you. Which strategy from today surprised you the most? Was it the Augusta rule? The hiring your kids strategy? The HSA hack? Engage with Tommy D. Heckman on social media? Share your aha moments. Let's get a real conversation going about keeping more of our hard-earned money.
And remember the closing thought from the book. Make the system work for your family, not the IRS.
Thank you so much for listening to the Plain Books podcast. If you found value in this, please follow, subscribe, and share this episode with a friend who you know is still digging with a spoon. Help him find an excavator. Until next time, keep reading and keep playing the game.
Goodbye, everyone.
See ya.